All right, guys. Well, happy Monday. Um, going to start a little bit different than today. So, we usually just kind of roll into these calls, assuming everybody knows who we are and what we're doing. Some of you guys have been on these calls for every week for a couple years now, and there's some new people that have joined us. So, just before we jump in, my name is Mike Smalley. I am a loan officer, run our kind of region division. I'm in Orlando, and you see a lot of our faces on our team here at Cross Country. So we've got typically 50 to 60 realtors and partners will jump on these calls. I think we've got people all over Florida and in South Carolina and some other states. So just wanted to thank you guys for jumping on these calls. So here's the objective of what we do. So give you a market update. What are we seeing? And that could be like macroeconomics. It could be geopolitical events. It could be interest rates. It could be loan programs. But we just want to give you kind of a high level of what we're seeing in the market, and then also give you some information and data that's impactful that you can share with your clients, whether they're buyers or sellers. And then hopefully we do a good enough job to continue working with you and earning your business. Love seeing everybody here. It's a great way to start the week. We do not shy away from talking about politics. Our opinion of how politics impact messaging is we have to put political beliefs aside and analyze what it means to the market. Our customers don't care if we lean left or right. Our customers care about themselves. And so we're going to talk politics a little bit today. And we're not trying to skew things towards, leaning one direction or another, but more how do policies have the potential to impact markets and how does that impact our customers? And I think it's important to put away your team red or team blue hats and take a step back and analyze like how do certain decisions impact things. So we're going to do a lot of politics today. So there's my warning.
Ooh,
So
I love it.
anyway, so let's jump in. So the markets are closed today. So it's kind of unique that we're doing this because normally I will be talking about what are rates doing today. I think it's actually a good thing that the markets are closed today because with what happened over the weekend and some tensions have arisen between the US and the EU and some, verbal and social media jabs back and forth, it would have led to a little bit of market volatility today. So probably a good thing the markets are closed. Let things settle down a little bit before they reopen tomorrow. Um, so let's jump right into that. Okay, so when a politician is in power, a president, and they are at the stage of their midterm elections, their number one goal, whether it's Donald Trump or Joe Biden, 4 years ago, is to keep their party in power. If they keep their party in power, they can push through their agenda. And so we've talked about this a lot. That what is President Trump's main objective? His main objective is that he needs to win the midterms. He needs to keep Republicans in control of the House and the Senate so he can finish his term and get his agenda pushed through the last 2 years and not be a lame duck
Yeah.
president. How can he possibly accomplish that? He can pass policy that is popular or populist that the general public will like, and hopefully that'll turn out the vote for him and help him get his party reelected and remain in control of Congress for the next 2 years. So a lot of the policies that you see coming out of Washington, and this isn't a Republican thing or a Democrat thing, it's the party in power during midterms, they want to be reelected. And so a lot of Trump's proposals are things that should, or at least for him, hopefully have some popular support. But you've seen a lot of things floated, and a lot of things floated that I don't think really move the needle a whole lot. 50-year mortgages are kind of a non-factor in our opinion. They've kind of backed off of that, portable mortgages, things like that. But there's some policies that have been pushed and implemented that could be positive for inflation, for interest rates. And the big picture is they really want affordability to come down. Um, I'm going to show the chart because I want to show you guys what's happened over the past year because it's important to understand what happened last spring because we don't want history to repeat itself. So let me share my screen. And if you remember when the president took office last January, um, immediately, hey, dude, but can you see MBS Highway? Cool. Okay. So immediately, what did he do? He pushed through some proposals or policies that would have been positive for energy cost, bringing the cost of oil down. Oil comes down, brings inflation down. Inflation coming down brings interest rates down, both mortgages and also like other types of borrowing government debt. Um, so this, I'm going to go through the last 2 years here. So when Trump took office last January, what happened? The bond market had a really big rally. Okay. And when the bond market price increases, yield or rates go down. So big rally here. Okay. After about 6 weeks, what did the president start talking about? He started talking about tariffs and a lot of tariffs. And it's interesting because if you love President Trump, you probably love that he's different than a typical politician. He governs by tweet, or it's very public and very much in the open. There's not really a lot of wondering. I wonder what Trump's thinking today, right? That's very different than many politicians. Compare that to Joe Biden. You didn't hear a lot from him, and things were probably done more behind the scenes, and you might have been left wondering, and or markets might have been left wondering what the policies are and what they're trying to implement. And so with Trump, that's not the case, right? Everything is in the public domain. Everything is a tweet or something on Truth Social. And so if you remember last spring, there was talk of tariffs. And even before the implementation of tariffs, you can see the bond market sold off big time. It was very volatile, and the bond market selling off here caused interest rates to go up. Now, what happened in around May of last year? Two things. The market realized that the inflationary impact of tariffs was not quite to the degree that they were concerned. And, this is a different policy than the United States has implemented for decades. And so nobody really knew if we impose tariffs on other countries, would it lead to inflation? And so the market freaked out a little bit because of the unknown. It just didn't know what to expect. And so you saw the bond market sold off big time. That's kind of like February, March, really through like the 1st of May. Bond market sold off, rates went up. And all of the benefit that we saw earlier in the administration was more or less wiped away. And we kind of got back pretty close to where things started in January. Um, Two things happened in May. One, some of the rhetoric was backed off, like we negotiated some trade deals. It was less in the public sector. We struck deals with South America and the EU and Canada and Mexico and China. And so some of the trade talk, like some of the rhetoric of we're going after these countries for trade imbalance and stealing trade secrets and tariffs, that backed off a little bit. And then the market realized that the inflationary impact of tariffs wasn't to the degree that was feared. And so around the 1st of May, we had a really nice bond market run, and you can see this. And that's been the last 8 months. The bond market's been in a really good rally mode. Interest rates have come down, and that's kind of like a high sixes to low sixes adjustment. That's been great for the market, good for the economy. Cost of goods and services have cooled off a little bit. Housing has become more affordable. And so we've been on a nice little run for a while. Um, Over the past couple weeks, there's been a lot of talk of what the United States trying to, I don't know what the right word is, but our involvement in Greenland. Let's look at that, okay? And so the president feels like, from a national security standpoint, we have to have control over Greenland, whether that's having a base there or buying Greenland, like we purchased Alaska, from Russia many, many years ago, or having greater influence. I think the big picture is the president and his advisors feel that from a national security standpoint, we have to be involved with Greenland. It's too close to Russia, right? And so, how are we going about doing that? Well, that's kind of the difference between Trump and other administrations. Much more in the public sector. He's a different type of negotiator, more of a private sector than public sector type of negotiations. So whether you like him or not, he definitely operates differently than a typical politician. And so what happened over the past couple days and weeks, and it really kind of flared up over the weekend, The EU, the European Union, is starting to put their foot down a little bit, and they don't like so much that the United States is talking about a greater involvement in Greenland. And the EU over the weekend is talking about imposing tariffs on the United States. So, and I'm going to put this in the chat, if the EU imposes tariffs on us, what do you think that will do to interest rates? Will that cause them to increase or decrease? What do you guys think? Okay, so we've got one answer from Jen.
Increase.
Okay, Aaron's an increase. Okay, and if for those of you
Increase.
guys that have been on this call with us for a while, you all know the answer, increase, right? Now, you have to take everything that the president says in public, either verbal or, like online, with a grain of salt. Is it a negotiation tactic or is it reality? I think they tend to be more negotiation tactics. I'm not sure what's happening behind the scenes, right? If the European Union is threatening to impose tariffs on the United States, is it a negotiation tactic? Are they playing Trump in Trump's game, or are they trying to do something different? Probably a little bit of a negotiation tactic, right? And so where I said it's good the markets are closed today, it'd be nice for a day or two to let things calm down and take some of these negotiations out of the public and behind closed doors. But again, the president operates differently, right? So he's going to go public on TV, news conference, quotes, tweets, social media, right? That's where he's going to put his initial opinion out there. And then he's going to let Scott Bessent, the Treasury Secretary, who's a really, really brilliant guy, to kind of do his negotiations behind the scenes. So I think that if the bond market was open today, I think rates would be moving higher on fear of potential and tariffs. What happens in the next 24 hours? Um, I also think that, and this kind of history, repeats itself. Do I think that the EU and the US are really going to get in some massive long-term trade war? Absolutely not. The reason I say that is if we go back to what's the president's number one goal, he wants to get his people reelected. He needs inflation and cost of goods and services to go down. He can't afford a fight with the EU where we start lobbing tariffs at each other, scaring the bond market, causing rates to go up. So I think you're going to see a little bit of an uptick in rates for the next couple of days as this works through. And then I think magically somehow there's going to be a tweet that announces a deal and everybody kind of cooler heads prevail. But if it persists and kind of the US and EU fight of over Greenland and they want to impose tariffs on us, if that lingers a little bit, then you might see rates tick up a little bit for a little bit longer period of time. Maybe rather than a couple of days, it could be a couple of weeks. But that's what we all should be watching right now is when you hear the word tariff, it doesn't mean inflation, but it scares the market that it could mean inflation, right? So it's not a guarantee that inflation's coming, but it puts the bond market in the back of their head that could inflation be coming? And that's the concern. So it'll be really interesting to watch to see what happens this week. I think the end result will be they'll work something out. And most of these fights we've got in, we get in a spat with India, we work out a deal. We get in a spat with Canada, we work out a deal. With the EU, we work out a deal. With China, we work out a deal. Some of them have been faster than others. And some of them are more impactful than others. A trade fight with the EU is a bigger deal than it is with some smaller countries. Just like with China, it's a big deal. So that's kind of what we should be watching this week. The absence of market related data for the next 2 or 3 days means this US EU tariff fight with Greenland as kind of the precursor, I think will drive things. But I think ultimately, if it's an uptick in rates, it's probably short term. This doesn't change our long-term view on where we think rates are going to go this year, which is probably continuing to inch lower at a slow pace. But for the short term, you could see a little bit of an uptick in interest rates. Um, we do get one really, really big piece of news this week. I'm going to share the economic calendar here. Thursday morning at 10 o'clock, PCE, the personal consumption expenditure, is released. That's the Federal Reserve's favorite measure of inflation, big market mover. I think the market will really look at it because the inflation readings we got in October and November were during the government shutdown when the data was less relied upon and people kind of didn't give it as much of a thought of is it accurate or not. So PCE for December gets released this Thursday. Big deal. So definitely going to be a market mover. Um, will have no impact on the Fed. The Fed's meeting later this month. They're not going to cut, but PCE will definitely be an interest rate mover. And so if we see a little bit of an uptick for inflation fears of tariffs, a good PCE on Thursday could bring rates right back down. So those are the two big things to watch this week. Um, I found this chart, and we talked about this on a couple other calls the last few weeks. If you guys remember that, I use the analogy of a rubber band stretching tighter and tighter and tighter, and at some point it pops, and the rubber band is like the bond market in a really narrow trading range. So I found this. This is from Bloomberg. This is the annual percent change,
Yes,
like
it is
during a year of the
stretching.
10-year treasury. The 10-year treasury is loosely what mortgage rates are based upon. And you can see, so like look in the 60s and 70s, there wasn't a lot of intra-year volatility, like the 10-year didn't go up or down more than 1%. Um, Late 70s, early 80s, that was like the oil embargo, hyperinflation during the late 70s and early 80s, a lot of intra-year volatility of the in the bond market. And then things settled down for a long time. Financial crisis, a lot of volatility. Things settled down. Here's COVID, a lot of volatility. And then this is the post-COVID inflation spike, some more volatility. But look right here. The 10-year treasury has only moved 0.08% in the last 30 days. It's basically been flat. And just like mortgage rates have been flat. And if we use that rubber band analogy, when the bond market's in a really, really tight trading range, the longer it goes, the tighter that stretches, the sooner it's going to pop. And if you think about a rubber band that you stretch, if you stretch it like this far and it pops, right, it's not going to like be a loud bang. But the wider it goes, the more impactful that pop's going to be when it stretches and breaks. And so at some point there will be some data that is a major mover of the markets and will get us out of that trading range where we've been, as far as interest rates. And just to go back to the bond market chart here, if we just go back over the past 6 months, I mean, rates have been very, very flat going back to really September. So all of the gains we had in 2025 were like May to September, and then September through the end of the year, more or less relatively flat. We are in a better spot today than we were incrementally, but it's been pretty flat. So at some point, we're going to break out of that trading range. I just thought that 10-year Treasury chart was kind of interesting and good to share. Um,
Hey, Mike, you got a question from Sharon.
Yeah, yeah, Sharon. So Sharon's question is PC adjusted for holiday spending? All of those economic data points, whether that's inflation reports or jobs reports, they're all seasonally adjusted, kind of for good or for bad, honestly. Like I think sometimes the seasonal adjustments might over or underestimate something, but yes, it's seasonally adjusted. Like people tend to spend more around the holidays, but people spending more doesn't necessarily increase inflation. It just means there's more, capital circulating in the economy. And really around the holidays, things probably get discounted, like holiday sales, things like that. So inflation, if it wasn't seasonally adjusted in the holidays, would actually probably look better than it is because a lot of things get discounted because people are buying, so much in bulk in their sales and things like that. Um, Okay, I've got a couple other things for you guys, and then we will probably get off a few minutes early today. So, um, one of the most common and kind of hot button loan programs that you guys hear is you hear people talk about non-QM loans. Okay, that's kind of a big buzzword. All right, if you were in the real estate or mortgage business pre 2008, today's non-QM would have looked like the early no income verification loans like 2002, 3, and 4, where if someone had great credit and 20% down, but they couldn't verify their income, they could still get a mortgage at a pretty attractive interest rate. That was like 2001, 2, 3, 4 or so. Okay. What kind of loan is that today? That's a bank statement loan, right? Now, what happened in 2005 is all of the underwriting criteria and standards actually analyzing, can this person actually pay this loan back, got thrown away and got replaced with exotic programs and some greed, right? And then the criteria of having a good credit and down payment, if you did improve your income, kind of went away. And it's like, well, we bad credit, no money down, no income. Sure, here's a loan. I'm sure you're going to pay it on time, right? And then we know how that went, right? And that kind of started the foreclosure crisis, which then spilled over to people that got traditional mortgages that verified their income and FHA loans and everything else. So the difference between today's non-QM and prior markets like non-traditional income verification is it stopped at 2004 and didn't go to what craziness happened in 2005, 6, 7, 8. And so today's non-QM loans are like the early 2000s. Like I never felt weird doing a no income verification loan for someone putting 20% down with an 800 FICO that was self-employed. Like that person was going to pay, right? They just maybe wrote off a bunch of their tax returns. Um, so when you hear non-QM, here's what I want you guys to think about. So there's three criteria you typically have to qualify for a mortgage: credit, assets, and income. Okay. Non-QM loans almost all have very good credit. Okay. Almost all have very good credit. They don't always have both income and assets to document. But it's typically assets and not income. And so, what are the two most common types of non-QM loans? Bank statement loans and DSCR loans. But typically, bank statement loans are people with good credit putting 20% down, and you can do them with less than 20% down. We're closing one this week. One of Dave's clients that's putting 10% down. So you can do them with less, but typically it's more. But when you guys think of non-QM, it's in some markets 15% of the market, in others it's like 35% of the market. It's a big percentage of the overall population. And I think as a realtor, if you talk about non-QM loans in kind of your social media channels and with customers, you'll find that you'll have people open doors that might not have thought of even attempting to qualify. So some buzzwords you can use, like in your marketing. If you have cash to put down, but you can't prove your income because you're self-employed, I know someone who can help. Like that kind of messaging, I think can be effective. Um, DSCR loans are popular for investors. And so if you're in that space in an area where, rental rates are good compared to prices, I would talk about, I wouldn't say DSCR because everybody thinks they know what that means. I would just say we work with investors. Like we don't really talk about DSCR loans. We just say we work with a lot of investors because there's a million different options for investors. DSCR just happens to be one. Um, we're going to be doing some specific non-QM classes in person in all of our markets over the next month or so. So if you guys have an interest in kind of the old school in-person lunch and learn, just watch your email. We're going to start putting some of those events on. I think it's really good for you to understand not just how the programs work. You're not loan officers. You don't need to understand the nitty gritty of it, but like understanding how they work and then how to take it to the market to bring customers to you. One thing I found is in our office in South Florida in the Jupiter West Palm area, our average loan amount has gone up about 20% because we're doing a lot of bank statement loans. Because who gets bank statement loans? Typically, it's self-employed people that are buying more expensive homes. And so, if you're trying to increase your average sale price, getting involved with like talking about bank statement loans or special programs for self-employed people can increase your average sale price, which is one of the three ways you can make more money, right? More leads, better conversion, higher priced homes. Um, the last thing I'll leave you with this is, so there's a few of us that are in a coaching program called the Core Training. Some of you have been in it. Some of you have heard of it. It's about 65% lenders, 35% realtors. So they coach both lenders and realtors. And every so often you talk to someone and you learn a lesson, right? So sometimes we have lessons that stick with us forever. It's not really a tactic, but just more like a lesson that you won't forget. And on my call last week, our coach shared a lesson with us that I thought was really impactful. I wrote it down. I'm like, I'm gonna think about that every single day. Okay. So if you're not generating as many leads as you like or closing as many transactions as you want, there's typically three causes, and it's really more lead generation if you're not bringing enough leads. Okay. So one cause could be I didn't talk to enough people. Okay. So didn't talk to enough people. Okay. So like we're probably all guilty at some point of getting stuck in your office, working on files on our end, doing property searches on your end, prepping CMAs, right? So that keeps us from talking to people. So who can we talk to? Like, leads, past customers, business people, like every person in America basically has the potential to buy a house or refer you someone. So one cause didn't talk to enough people. Um, the second is we didn't talk to the right people. Okay. And we're going through that now. Like our team early in January spends a lot of time following up with old leads. And you all are probably too, people that you had had conversations with in 2025 or maybe 2023, 4, 2, like, but a lot of people in the past few years had conversations with both of us that didn't purchase a house for whatever reason. And so we're trying to kind of shake trees a little bit, um, see who of those people is a serious, potential buyer of a home in 2026, kind of re-engage with people. But when you're doing that, if we're calling 100 people, I'm guessing not all 100 are serious buyers this year. So we have to identify who of those 100 prospects is a serious buyer, right? And so the second piece is you didn't talk to the right people, right? So didn't talk to enough people, didn't talk to the right people. And then the third piece is didn't say the right things, right? So that's kind of a scripting thing or didn't ask good questions. Like we talked too much without asking questions. So anyway, I wanted to share that with you because I wrote it down. So again, if you want to increase your transaction count or your lead count, um, the question is, did I talk to the right people? Did I talk to enough people? And did I say the right things? So thought I would share that. All right, it's 10:59 or 10:29. Appreciate you guys jumping on today. Have a great day. Have a great week. Watch the news of EU and US tariffs. That'll be market moving. And then 10 o'clock Thursday morning, PCE, CNBC, Fox Business. Tune in. You'll see it live. That'll be a market mover. And we'll talk about it all next week. Thanks, everybody. Have a great week, and we'll see you next Monday.